The FANG stocks are usually buoyed by the first to report good earnings. It didn't really happen this week. What's going on?
Clearly each reflects the overall economy and each is global. Netflix in particular, though, has been a content story. And as their content gets better, and especially up against a pretty easy comparison a year ago, they see subscribers join. And I think really more realistically, they see fewer people quit. They've gotten to the critical mass on content where they keep something coming out virtually every week. And so it really keeps their subscribers happy. They tend to churn less, which drives the overall net ad. That's not the same story for the guys who are advertising dependent. They're far more sensitive, to the global economy. So I think when people talk about a looming trade war with China, there's concern that perhaps that throws the U.S. and the globe into recession, which means that you'll see a depression of ad spend. So different for Netflix than the other guys.
Luke, what are you seeing? Is this related to anxiety around advertising, or are there also some macro factors here, like worries about a trade war, interest rates, and the situation with Saudi Arabia?
I'm sure the macro factors are playing somewhat of a role here, but for me, the real story is that lack of halo effect in terms of Netflix's strong results not really rubbing off on the rest of the FANG group. And the part of that story is really related to something more technical in markets. It's an ongoing factor rotation we're seeing. So, the FANG group is all part of what we like to call momentum stocks that generally have had strong uptrends, and you bet that the market winners will keep on winning. The stock tumult that we've seen in recent weeks has also been associated with a factor rotation to value stocks over momentum. And what you see in the market right now is, on an intraday basis, momentum and value are trading off day by day, hour by hour, back and forth. So it's a listless market searching for what the direction and what the leadership will be. And that's why I think the upcoming earnings from the rest of the big tech group will be very important to resolve the shape of the market and determine market leadership from here out.
Well, let's take these companies one by one. We have a pile-up of earnings over the next 10 days. Michael, including Amazon on Thursday. This quarter is going to reflect Prime Day. They've had a couple of quarters where they're showing, really for Amazon, surprising amounts of profit per share. So what are you expecting from Jeff Bezos and company next week?
They turned on a dime from kind of stumbling in 2014. They were growing their spending faster than they were growing their gross profit dollars. And after 2014, they started just spending a little bit less. We have them generating about $25 billion of gross profit growth in 2018 compared to 2017, and spending about $21 billion of that, which leaves $4 billion to drop to the bottom line. When you only have 500 million shares, it's pretty easy to generate massive earnings growth. So first half this year, they've thrown off over $8 a share in EPS. Last year, under $2. I think that trend continues, and I think you're right. Prime Day was a big driver. Amazon, to coin a very famous author's term, really is the everything store. And they sell everything. And this is where we go. Our default searches now for products are on Amazon. We used to search on Google. So that's the one that I think is going to stand out. I don't think they can miss.
Thank you for that, Michael. Luke, let me ask you about Facebook. So much controversy, particularly with, fake news and voter suppression efforts ahead of the midterms. And yet analysts seem to be worried about something more trivial, which is, margin compression and the rise of operating expenses. What are you expecting from Facebook a week from Tuesday?
Well, that's hardly trivial to analysts. I think that's what really matters in terms of the stock's profitability and whether you want to own it. I don't think Facebook is a moral theater for a lot of people. It's a profit center. And to that point, I think across the board with the FANG stocks, what we're seeing is people are pricing in bigger implied moves from options this earnings season than they have in the previous 3 on average. And with regards to Facebook's margins, it's interesting because they have a tendency is they start off the year with relatively high expense guidance, and then they tend to trim that as the year goes on. This has been a departure from the norm in this year. So on the one end, you have the creeping expenses, which are in part associated with kind of your fake news monitoring costs. And on the other hand, you have the potential for less targeting abilities to crimp margins on the upper end too, in terms of what you're able to promise to ad providers. To a large extent, I believe that analysts think Facebook is able to offset that by virtue of having a lower ad load, kind of cleaning up the news feed, and being able to command a premium on lower volume.
Michael, let me ask you about Google. You know, it's had kind of a miserable couple of months in terms of the stock price. Clearly worries about government intervention, rising marketing expenses. I've heard you be more bullish, though, about Google's long-term potential. So what are you expecting next Thursday from Google?
You know, I've been covering them a whopping 2 days, so I'm far from an expert. I think the street's got it wrong on this quarter, and I think the thing to look at is the top line is expected to grow sequentially over $1 billion. The street has them at 1.35 billion. We have them at 1.6 billion, and the street thinks we're going to see a sequential decline in EPS. I don't see how that's possible. The company warned that marketing expense would be higher, but the street has marketing expense literally something like $1 billion higher sequentially. That's just crazy talk. So I think Google is going to blow numbers away. I think they figured out the formula, which is don't spend all of your profit and investors will reward you and their share price will go up. They pay their employees in stock. Everybody, you know, who's a constituent of Google cares about the share price. So I think they're going to blow numbers away. The ad market's super strong. Google is really diverse, you know, beyond search. I mean, they clearly are on mobile. They've got the map function. They've got YouTube. They are hitting on all cylinders. So I think you're going to get a nice positive surprise.
Michael, really quick question. Why China? You know, why this Dragonfly project and taking on such regulatory and reputational risk? I mean, is Google running out of big markets?
Well, everybody would love to be in China. It's obviously a very large economy. And, you know, I think that you're right. I mean, it's a trade-off risk-reward. Risk is huge, reward is huge. I think Google thinks they can dominate that market. So I think that they're willing to take the regulatory risk. I think they're willing to take the reputational risk. And I agree with you. If they misexecute, it's going to be a huge, huge black mark. Let's hope they figure it out, or let's hope they move very slowly and don't screw up. I think the only thing that'll trip them up is if they try to go too fast.